continues to hit new record highs, punching through the 23,000 mark this month, with the 24,000 mark seemingly in its sights. While here in Australia, the All Ords briefly pushed through 6,000 points for the first time since 2008. Some analysts are urging caution and warn a tightening of interest rates globally could see markets take fright and dive. Here's Carrington Clark.
The Dow Jones Industrial Average topped 23,000 and kept going.
Markets in the US are continuing to soar, and it's been fuelled by easy access to cash.
I think cheap money has been the defining influence for the rally that the markets have had since 2009.
They're record highs, but not necessarily unwarranted.
They're definitely looking expensive, but I would classify that as rational exuberance rather than any irrational exuberance. I think you can make a logical and rational case for high equity prices today if you assume that interest rates are going to stay low for a long time to come.
With the latest US economic growth figures a very healthy 3% per year, that run might not last much longer.
I think inevitably there's a reckoning to these things, as we've seen in repeated business cycles, and it is usually interest rates that brings it on. It was last time with US housing. I think it will be again this time.
And David Llewellyn-Smith says if history is any guide, it could be messy.
What I can say is the last two cycles that have ended on Fed tightening have halved the stock market.
Equity markets are priced for 4 to 5% returns. If people start demanding 8 to 10 all of a sudden, then you've got equity prices half of where they are today.
There is speculation that US President Donald Trump has decided relatively dovish federal board member Jerome Powell should step up into the role of governor once Janet Yellen's current term ends next year. But with asset prices like shares surging, there is concern continuation of cheap money will further distort markets.
It is a very difficult thing to do, to be the person that preemptively pricks an asset bubble, and in some ways we're in too deep. I mean, asset prices are all based off interest rates being low already, and we're beyond the point of being able to stop that from happening.
It's predicted the Federal Reserve will hike rates as soon as December, with at least 2 more next year, even though it knows interest rate rises will hurt the share market.
I don't see an easy out. There is no, we're going to put interest rates up to 3 or 4% and it's not going to impact asset prices, because it quite clearly will. And there's no easy way out of the scenario. It's a consequence of rescuing the world economy from where it was 10 years ago.
And higher interest rates will also lead to a higher dollar, which is also a problem.
If we start to see a substantial and sustained rally in the US dollar against its peers around the world, that is also going to add to the deterioration of earnings for companies in the United States.
Which might be a reason for the new US Federal Reserve boss to hold off, if they can.